Global markets kick off a new trading week with a bit of a mixed picture. President Donald Trump's tariff threat on the EU, the European Union, followed by a subsequent delay, boosted European and Asian markets, while U.S. equities opened lower. This is, of course, the futures market, the cash markets closed for the holiday. So what is shaping markets for this week, and what signals is our next guest looking for clues about the path forward? Joining us here today to unpack the macro themes on his radar and to set you up for this trading week to come is Fidelity Director of Global Macro, Jurrien Timmer. Good morning, Jurrien. Great to see you. How are you today?
Good morning. Happy Memorial Day from your friends down south.
Well, thank you for joining us on Memorial Day. We're very grateful. It is a holiday, so thank you. Good to see you.
You're my half hour of work on this holiday, but
really?
It's well worth doing. So.
Oh, you're the best. Okay, well, thank you. We invite everyone to join us here for this half hour with Jurrien Timmer. Send questions in. Do that. Tell us a little bit about where we've come, because it has been a fascinating track, pretty much right back to where we were prior to April the 2nd, and a very quick one, a true V-shaped, actually, if you will.
Yeah, so let's bring up slide one. So it has been a pretty startling ride. You know, we kind of came out of nowhere and fell 21% in a matter of 6 weeks. And then we did a V-shaped recovery, almost back to the highs. This chart here shows what happens after a 20% decline. So the black line is the current cycle. And you can see we're following pretty much the most positive rebound you tend to see after a 20% decline. So this has been really good. If we took a 6-week nap, you know, we would wake up and be like, okay, nothing really happened. But of course, we know how much has happened, especially for you folks across the border. So the question now, of course, like what happens next, all right? And if we look at slide 2, you can see just a zoom out here of the S&P 500. You know, when we declined the 21%, we came down to the previous high that held, and we just bounced very strongly. But for me, this now puts us in maybe a little bit more of a clearer situation, because what we saw, of course, last week was that, well, we saw two things. One is the 10-year yield went back into that 4.5-5% zone, and the 30-year Treasury went above 5%. And you know, as I like to say, that there used to be a saying that nothing good ever happens after midnight, and I would adjust that saying by saying that nothing good happens when the 10-year yield goes above 4.5%. And so we started to see that pressure that we've seen so many times now over the past few years, right? 2022, of course, was driven by higher rates, and then we had several sort of little rate tantrums as the 10-year yield went towards 5%, causing wobbles in the stock market. And you and I have discussed this many times. So that started up again last week. And at the same time, our president started talking about tariffs again. He started uttering the T word, this time directed at Europe. And to me, that's very interesting because, as we know, when the market was down 20%, the policymakers retreated a bit, right? They put they shelved the tariffs to China for 90 days, and of course they had shelved the other tariffs, the retaliatory tariffs, to all the other countries for 90 days, and so it was a White House put instead of a Fed put. But then, as the market recovers, people get more confident. They figure, okay, you know, the market's like this. And lo and behold, you start hearing the rhetoric again. So that tells me that there are kind of like bookends now to this rally, right? I've long favored sort of this trading range idea for 2025, where earnings are growing, but the PE, which has already expanded a lot over the last couple of years, we can pull up slide 4 here, will start to come down as that Fed model starts to kick in. The Fed model meaning that as yields go up, they start pressuring equity valuations, because equities need to compete with the risk-free rate. And if that risk-free rate gets close to what equities are yielding, the PE has to come down to reprice and remain competitive. So here you see the PE side really carrying the load over over the last couple of years, anticipating an earnings recovery, which did happen. Earnings did rise 11% last year, but that cycle seems to have peaked. And now the PE side has given back some as well. So what this tells me is that we have, when the market goes down, we have that policy put coming back in, right? So if this EU talk causes the market to kind of go into another tailspin, which I don't expect, but then as the market recovers, that rhetoric comes back and the Fed model kicks in. So all of that tells me that a trading range environment is probably the most likely outcome here for the next 6, maybe even 12 months. Which is not the end of the world, right? No. Trading ranges happen. Again, if we pull up slide 2 for just a moment, when you have strong advances, and again, we had 2023, 2024, both 20+% gains driven by mostly multiple expansion. Having a flat year, which is sort of like in that range of down 20% to even, is something we've seen many times. 2015 was such a period. 2018 was such a period. And so to me, that seems like the most plausible outcome here until this whole episode kind of gets worked out. The next week, after that Liberation Day unwinding of the bond basis trade, that's when the S&P fell another 10% after having fallen 10% already. And I think at that point, things got chaotic enough that everyone had to pull back. So if the market goes down 10% from here, I don't think much will happen. But if it starts to get really kind of disorderly, I think they will withdraw yet again. And again, all we've had is 90-day pauses, right? So nothing has really changed, but a lot can happen in 90 days. Deals can be made and all that stuff. And so that's, I think, how kind of this chess game is going to be played. So
you mentioned there that, from here, potentially, if something went offside, you could see perhaps a 10% pullback. But it brings into the discussion the Fed model, which you mentioned a couple of times, which actually has a lot to do with the bond market and whether you go ahead and take some income from owning bonds versus you take some income or growth from owning equities. There's sort of that push and pull. Can you just take us inside there? Because it speaks to the range-bound story.
Yeah. So let's discuss the Fed model. Let's go to slide 7, and I'll just kind of back this up a little bit. So we have the bond market. This is the 10-year yield. The bottom panel shows the term premium, that is the risk premium on long-term bonds. And given this new era of fiscal dominance where a lot of treasuries are going to have to be issued with no obvious buyers picking up the slack, right? The Fed is still doing quantitative tightening. So there's no uneconomic buyer there. And as you see rates go up, actually, let's go to slide 6 for a moment first. And as you see in this chart that bond yields for the major countries, other than China, which is another story, right, have been rising. Even in Japan, right? The yields are way up now. And so if you're the Bank of Japan and you're looking at yields rising and you're not doing QE anymore there, you're less inclined to buy U.S. Treasuries with your surplus, dollars, because you might have to prop up your own market. And
that is a brilliant chart. Wow, look at that. Yeah. That sort of tells the global story.
So now let's go to the next slide. So there are no or fewer uneconomic buyers, meaning central banks, large institutions, than there have been. And Scott Bessent can't really do what Janet Yellen did in 2023, which is when yields rose to 5%. Yellen just switched the maturity composition of what she was going to issue, and she switched from bonds to bills, which she could do at the time because there was $2 trillion sitting in reverse repos that money market funds could just, instead of renewing the repos, they can just buy bills. So there was a natural buyer of those bills, but the reverse repo program is basically done. So there are no natural buyers of bills. So there's really no easy out for the Treasury now to manipulate kind of the maturities and therefore push rates down. So rates are moving higher. We're 4.5, 5 on the 10-year. If you assume, as I've done in this chart, that the term premium goes back to its historical norm of about 100, 150 basis points, you could see a 10-year yield well above 5, okay? Now, the reason that's important is to the next slide. If you take the PE on the stock market of 20, 21, 22, and you invert it, you get an earnings yield of about 4.75 or so. If you take the yield on the Treasury, it's 4.5. So the yield on Treasuries is very competitive with the yield on equities. And so a couple of things we know in this chart, I love my scatter plots, as you know.
That is a great one, yeah.
If you look at the 10-year yield on the horizontal and the stocks to bond correlation on the vertical, you can see that the higher yields go, the more correlated the bond market becomes with the stock market. So this is not the correlation of yields to the stock market, but of bond returns to equity returns. And so as yields go up, and they go from 3 to 4 to 5, and who knows, maybe higher, that yield will become more and more competitive and will be more and more correlated, or the return will be. And then if we go to slide 9, you can see a period back from the 60s to the 90s, which is the orange line. So again, I'm looking at the bond PE in the horizontal, so that's the inverse of the yield, and the equity PE in the vertical. And you can see a clear sort of positive logarithmic correlation where when the bond PE goes lower, so the yield goes higher, the equity PE has to compete with that and go lower as well. And I'll put one more actually, I don't have the chart here, so never mind. I won't do that. But so what this means is that if the 10-year yield went from 4.5 to 5, the scatter plots suggest that the equity PE, which is now at 21, would drop 3 to 4 points. So that it would go to 17, 18, which is not the end of the world, especially considering that
it's back
earnings
up at 20
growing,
something now, right?
Earnings are growing 7%. Mm-hmm. But if earnings were not growing, a 3 to 4 point decline in the PE would be 15, 20% in the S&P 500.
Okay.
And so if that's then offset by 7% earnings growth, you get about maybe 10, 15% decline. So that's just a way to quantify what we were talking about earlier with that range, right, for the stock market. So my guess is that the range would be defined as down 15 from the highs, and then the old highs, which we just tested, as the upper range, and then the down 15% as the lower range. So that's kind of how I see sort of this pendulum going back and forth.
It's fascinating. Tell us about the bull market, which we've been sort of talking about for some time. The length, you did a number of studies on how long bull markets are and midpoints and how much of it. The one that we're either in or finishing up, we're not sure, began in October 2022, and that was in the midst of, that was essentially when the Mag 7 took a dive there for a bit, and lots of other things happened too. Are we still in that bull market?
So let's look up slide 3. So the median length of a cyclical bull market, so I'm talking about cyclical, not secular.
Right.
The median length is 30 months. And of course, the median, as it always is, can be very misleading just because you have a very wide range of outcomes where some bull markets are shorter, some bull markets are much, much longer, but that's the median. And so this is every meaningful correction of at least 10% from the peak. And so that October 2022 bull market turned 30 months old in February, which is exactly when the market peaked and started to go down 21%. On this chart, it shows 19 because it's from close to close. And so the question is this just a bear scare or is it the start of a bear market? If it's a bear scare like what we saw in the fall of 2018, and the market immediately goes to new highs. And actually, let's pull up slide 1 here. That might be a better representation. You know, that purple line there was the 2019 recovery of the 2018 20% decline. So no one thinks of that episode as a bear market, right? Even though the market went down 20%, because for a bear market, you need not only price, and it doesn't have to be 20%. You can say a bear market was 15% if it produced a range that lasted for 2 years. That was probably a bear market. But so you need price and time. And 2018 was price, but not time, because within weeks we were at new highs. And so that was not a bear market in my view. So if in this case, we already fell 21%, if this is the start of a range that lasts maybe 6, 12 months, who knows, then I would say that's a bear market because you will have satisfied both the price, 20%, and the time, let's say 6 months plus. So if that's what we get, and I feel like that's likely because I don't see what the recipe would be for an immediate resumption of the old bull market, because earnings growth is slowing. The valuations are back in 21, 22 times earnings. The Fed model kicks in. I don't really see the ingredients for a sustained bull market here. So my guess is that bull market did end. And we are now in a bear market, but it's a modest one, more driven by time than price, and one that probably will not produce a recession or may not produce a recession based on what earnings growth looks like right now.
Yeah, because earnings growth is strong still. We're all waiting for Q2 because that seems to be when it should capture some versions of decisions made in the wake of April 2nd. That said, though, just tell us a little bit more about that time pocket or window itself. Does that require a real tariff rollback? At the moment, of course, there's more bellicose commentary about the EU, tariffs on the EU, much bigger 90-day period and so on. But it's front and center yet again.
Yeah, I'm sure, and we know, right, we know from the history of this president that, there's a lot of talk and different things get said all the time. And the reason why the market kind of freaked out earlier this year, because it really looked like it was serious this time, that the tariff talk was not just a means to an end, but the end itself. And then, we went down 20%, and lo and behold, some of it was walked back. They weren't reversed, but a time element was introduced, which would have made sense anyway, right? You can't just change everything overnight. These things take time. So we do know that those pivots happen, and I think that gives the market some confidence that it doesn't have to fall 20% again before getting that fiscal to be put back in place. So I think the market will learn from that. It's like machine learning, right? So the market may go down 10%, but it's not going to go down 20, and then we'll just see. But I think the risk is that longer term damage is being done because this is not helpful. Like, I understand the reasons why this is happening, and obviously if one country tariffs us and we don't tariff them back, then that's not fair either. So I get it, but the risk is that foreign capital just starts to repatriate, that they just start doing other things. And international investors own 30 trillion of our stocks and bonds. It's not an insignificant amount by any means. And so when you look at the dollar, like again last week, the dollar back to the lows of the range, yields pushing back up, stock market under a little bit of pressure, even though it's still near the old highs. It seems to be that when one U.S. asset sells off, all of them sell off. It's the dollar, it's bonds and equities. And it doesn't have to be a massive unraveling in a very chaotic way, but it could be a slow drip of just foreign investors looking elsewhere to put their dollars or yen or euros or loonies or whatever. And if that's the case, then the U.S. will lose its supremacy premium. I guess that's a good word to use.
That's a good word. That's yours. You coined that. Yeah.
Yes. So the supremacy premium, the world might become a more level playing field in terms of that exceptionalism in the U.S. no longer being taken for granted. And that creates a lot of opportunities. And if we can just go to slide 14 for a moment, it's really interesting that if you look at the leaderboard, and this is on a 3-month basis, so this is not my usual periodic table that shows calendar years, but this is on a rolling 3-month basis. You look at who's on top, right? Gold and Bitcoin together again. They tend not to move in the same direction at the same time, but right now they're both playing on the field. And below that, you have IFA, you have ex-US, you have emerging markets, you have cash. And so
Yeah, let's talk
these
about
are
cash in a
all
minute.
the assets that for years were kind of left behind, except for Bitcoin, and that have now are having their moment. And I think that's the kind of environment that we need to be looking at. So it comes back to the question of the alpha versus the beta. You know, if we're in a new cyclical regime in the US and possibly the cresting of the secular regime as well. Remember, we're 16 years into this secular bull market, driven by a lot of the things that are kind of being put up for question right now. So if we're in an environment that is going to produce less beta, at least for US investors or for investors investing in the US, then the alpha stream will become more important because it'll make up more of the return than when you're used to just getting lots and lots of beta, like the alpha is not as important. Right. So non-US equities, a weaker dollar, pressure on PE ratios in the US from rising yields. Again, that doesn't mean the market has to go down. It's just you get that offset of PEs offsetting earnings growth. And then these alternatives, right? Hedged equity, managed futures, absolute return, cash-based strategy. I mean, cash is competitive. We're at 4 3/8, and I don't think the Fed's going to cut rates. And actually, I think we have time.
Yeah, do that. There's 2 questions coming, but I was hoping we'd get to that.
Let me just show the Fed real quick on slide 11. I think this is fascinating. So this is the money supply in the purple, the 2-year CPI rate, so the 2-year rate of change for the CPI, and then the Fed, of course, and then those dots are the TIPS break-evens. And so what you see is that the Fed, of course, eased rates last year. It is expected to ease rates further. It has in its own dot plot 2 cuts this year, 2 cuts last year, but the Fed has been very patient, rightfully so. And of course, Powell's not going to let President Trump tell him what to do. So the Fed, I think, is playing the game pretty well here. But if you look at the leads and lags in this chart, right? So in 2020 during COVID, the money supply absolutely soared. A year later, the CPI soared. So you got monetary inflation leading price inflation. And then a year later, the Fed had to go from 0 to 5%. Then the money supply started to shrink, the CPI started to come down, and the Fed started to ease. And that's all well and good. And the TIPS break even shows that inflation hopefully has been tamed. But look at the money supply. It is back at the old highs. And so we have to be careful, and the Fed, I think, is rightfully careful, that this renewed increase in monetary inflation does not, put the kibosh on this lower inflation scenario. And I think that's one of the reasons why the Fed is going to pause here. And it does harken back to that late 60s analog, which we've discussed many times, where the Fed prematurely pivoted, and then it had to take it all back because inflation had not been tamed.
Was M2 the issue then too? Was M2 one of the issues then?
Yeah, and it's not just the U.S. M2; it's global M2, and that's, of course, if we go to slide 15, that's been the gold story as well. Yes. So the global money supply is now at a new high at $112 trillion. And gold has been moving in lockstep. And so this is what gold and now Bitcoin as well is telling us, that, gold has historically been a hedge against either negative real rates or monetary or price inflation. And so that's, I think, part of the story here.
That is fascinating because we don't always think about cash being all of those different things, but it is, as you say, and it inflates it. There's a couple of questions here on debt. One of them, so there's been debt downgrades for the U.S. This question goes to that. With yields higher, do you have any concerns around U.S. debt downgrades? Yeah. What do you think of those? Are these marketing headlines? Are they real? What do you think?
The downgrade itself was not news because Moody's had already put the U.S. on the downgrade list a year earlier, and both S&P and Fitch had already downgraded U.S. debt. So that on its own was not a surprise. And of course, we just have to look at the deficit spending and the debt to GDP and the outlook for that with, entitlement spending and defense spending and just debt service alone, which is now $1 trillion plus per year. So we don't need a credit rating to tell us how bad the situation is.
Yeah.
And the only reprieve for the U.S. is that other countries are just as bad, Canada included, but
Yep.
Japan, China, Europe. So you get into the cleanest dirty shirts situation, but even the U.S. may not be the cleanest dirty shirt anymore, because the U.S. is on a pretty bad path, and it's now making enemies, right? I mean, people look, again, not to be critical of our elected officials, but this notion that if we're running a trade deficit with another country, that somehow they're taking advantage of it is just like insane, because we might have a goods deficit, but we have a service surplus, and we certainly have a capital deficit where our yields would be a lot higher if it wasn't for the $8 trillion of foreign money sitting in our treasury market. So it's a very, very dangerous game, and so I think that is the most concerning, because very little of the budget in Washington is discretionary. And we had the whole Doge thing, and that's really hasn't moved the needle very much. Like, it really hasn't affected jobless claims very much either. So it's an unsustainable path. And Scott Bessent rightfully says that we can't really lower the debt, but the only hope is to outgrow it. And that's correct. I mean, that really is the only hope, because I don't think there's really enough meat or fat in the debt that you can cut it without any real pain to the economy. So you have to outgrow it, which is hard to do when you have a demographic story as we do. Productivity is really the only hope, right? Because if you look at potential GDP growth, it's labor force growth plus productivity. So maybe the AI productivity story will save us. But at the end, the bottom line metric to look at is the difference between nominal GDP growth, which is probably around 5%, so real growth plus inflation, and the nominal yield on the 10-year Treasury, which is at 4.5%. So as long as the growth rate is above the funding rate, it's considered sustainable. But let's say if the growth rate went to 4 and the Treasury yield went to 6, that would be a disaster. Then you would have some sort of stagflationary scenario that you cannot get out of. So let's hope it doesn't get there. But that would be a rule of thumb of how to look at this. And you can do that from country to country. Could
deregulation really move that dial?
It could, yeah. For sure. And not only in the U.S., but in Canada and in Europe elsewhere, right? Because the rest of the world has gotten a wake-up call here saying, we need to do this alone, right? The U.S. is not going to bail us out if Russia goes to war with one of our neighbors or this or that. And so we see that in Germany. They had to wake up and say, okay, you know what? We're going to have to abandon our debt to GDP target, and we're going to have to just fiscally inflate ourselves. And regulation is very low-hanging fruit in that sense. I mean, the EU is so highly regulated that if they just regulated less, you could unleash those animal spirits, which then would allow the rest of the world to compete, with the U.S. and compete with their own debt. So maybe that's the silver lining that of this sorry mess that helps everybody.
Yeah, fascinating. We'll talk more about that with you next week. So delighted that you could share your time with us. Go back to your holiday. Thank you very much, Jurrien Timmer, for joining us here today.
Thank you. See you next week.
All the best.